In this video, we're going to check in on the results of a video I put out last year pitting CEF Mastery's highest ranked funds against AI's top 10 picks. Topics in this video will include a net asset value performance recap, NAV performance since last year, market performance since last year, distributions, and returns for both portfolios using the Divi-X system. Closed-end Fund Mastery and the Divi-X system are two completely different programs that operate independently from one another, but I often combine the two programs because they work so well with each other. I was going through previous videos on my channel and I noticed that one of the videos I published, CEF Mastery versus AI, had been out for a little more than a year now, and I thought it would be a good idea to revisit the funds that AI picked back then to see how CEF Mastery's picks have held up against them. Anxious to know the results myself, I hurriedly went ahead and compiled all the performance data for all 22 of these funds over the past year, from October 7th, 2024 to October 5th, 2025. After I had collected all the performance data and then compared it to the data I published in the video, I noticed that the time frame had been a little longer than a year, going back to May 31st, 2024, not October. So I had to redo the fund performance worksheets to include all the time that had passed, 16 months in total. However, I wasn't going to let all the work I had already done go to waste, so what I decided to do is compare both performance data sets. Just a quick recap of the results I published back in May of 2024. Then CEF Mastery's top 10 picks, or I should say CEF Mastery's highest ranking funds at the time, outperformed AI's top 10 picks for the 3-year annual average by 5%, with AI having total returns with distributions reinvested of 2.04% compared to closed-end Fund Mastery's top 10 picks of 7%. The 5-year annual average closed-end Mastery top 10 picks outperformed AI by over 4%, and for the 5-year NAV average, Mastery's top 10 beat AI by over 32%. Now in the last video, we focused primarily on net asset value, and I didn't bother to look at the CEF Mastery fund scores at the time. I just went by rank, the 10 highest ranked funds. In this video, we're going to look at everything: NAV performance, market performance, score behavior, and distributions. Beginning with the NAV performance 1 year later, up to October 5th, 2025, all CEF Mastery qualifying funds continue to outperform AI for the 3-year distributions reinvested, 17.5% to 15.59. The 5-year distributions reinvested, 12.2 to 10.7, and the 5-year NAV price change, 13.5 to 3.72. Below that is the broader high-yield closed-end fund market performance, ex CEF Mastery qualifying funds. For the 3-year, returns are 11.3%, for the 5-year 6%, and negative 15.8% for the 5-year NAV price change. For Mastery's top 10 picks, they continue to maintain a decisive lead over AI's picks at 21% for the 3-year, 16% for the 5-year, and 42.5% for the NAV price change. Before we move on to market performance, I would like to point out that CEF Mastery does not speculate on future market performance, but focuses on 3 primary goals: distribution sustainability, long-term appreciation potential, and being well positioned for distribution increases and special distributions. Keep these goals in mind as we review our results. As for AI's approach, we have no clue what its focus is. The only criteria I posed to AI at the time was asking what the 10 best closed-end funds were, and it shot out a list of 10 funds with no explanation. I'm sure I could have prodded it for more in-depth analysis, but it wasn't the focus of the video at the time, just strictly top 10 versus top 10. I do know, however, that AI's approach was more aggressive because the amount of yellow and red scores among AI's picks. If we look at AI scores today compared to a year ago, ago, you notice a lot less yellow and red, more green, and two of the AI funds picks, UTF and UTG, have entered into CEF Mastery qualifying status. And see that little 5.26% distribution increase? That happened after gaining CEF Mastery qualifying status. We'll cover the distribution picture later. Okay, let's get started with the results beginning June 1st, 2024 to October 5th, 2025. Here on the left-hand side of the page, the day after May 31st, AI has taken a 2.1% lead over CEF Mastery, 27.7%, compared to 25.6%. Exit out the two rolling quarterly NAV funds, the fund FUND and RMT, as I also did in the last video, and replace them with the next two highest ranked funds in closed-end fund mastery at the time. That lead narrows to only 1.1%. If you're wondering what a rolling quarterly NAV fund is, or RQNAV, it's basically a fund that changes its distribution every quarter based on previous NAV performance. If NAV goes up, distribution goes up, and vice versa. Now, parsing through our results, when I did the AI versus CEF Mastery comparison last year, I did not know that two of the funds were CEF Mastery qualifying funds, which didn't surprise me. But what did surprise me was that 8 of the funds selected by AI were not CEF Mastery qualifying funds, which is good, I suppose. Otherwise, we'd be comparing the same funds against one another, and that would be pointless. Now, if you're wondering what constitutes a CEF Mastery qualifying fund, it is any fund that has the combination of a score in the green, the number of distributions remaining in the green, and a final score in the green. The lack of CEF Mastery qualifying funds and many of the lower scores in AI's picks reveals to me that when selecting funds, AI was most likely using technical analysis in its selection, choosing funds it deemed ready for a break to the upside, which is cool for the short term, but it's not always successful, and short-term speculation doesn't necessarily equate to long-term success. We can see this with the fund BME. From the period of June 2024 to October 2025, it only gained 5.9%, with distributions not reinvested. If you look over here on the right, over the last year, October 24 to October 25, BME's performance is negative 0.7, a decline of 6.6%, reducing total returns to only 5.9%, which was made entirely from the 4-month period of June 1st to the end of October 24th. I'll do one more example to illustrate because I know this may look a bit confusing. Let's look at the fund HTD. Since June 2024, it returned 17.5%. Since October 2024, only 3% contributed to that 17.5% total return. This means that 14.5% of the total return was made in the 4-month period from June 24th to October 24th. As a matter of fact, the bulk of the returns for a lot of these funds were made in the first 4-month period from June to the beginning of October. This is why I'm glad I decided to keep both time frames. The returns in the 4-month period from June 24th to October 24 are considerably different than the 12-month period of October 24 to October 25. This also adds weight to my speculation that AI was looking for short-term swing trades and not long-term investments. And if I may say, I do not think AI did a very good job on its short-term picks. When compared to CEF Mastery, which does not focus on short-term price movement, returns are pretty much on par overall, with a notable exception of UTG, which garnered 55.8%. That's only 1 in 10, or a 10% above average success rate. Remove that big winner and AI's picks only averaged 24.6% over the last 16 months. And if you'll allow me to lovingly pick on AI just a tad bit more, if we look at the results for the period of October 24 to October 25, the fund UTG acquired CEF Mastery qualifying status, where the bulk of that 55.6% 25.8% was earned, which is 31.6%. For both portfolios overall, AI averaged 27.7% from June 24th to October 2025, with 15.1% being earned from June 24th to October 24th, the first 4 months. And CEF Mastery averaged 25.6%, with 7.2% being earned from June 2024 to October 2024. In the last 12 months, AI earned 12.6% on average, and CEF Mastery earned 18.3%. Moving on to other things of interest in this comparison, over the past year, 2 AI picks, UTF and UTG, entered CEF Mastery qualifying status. Over the past year, the fund UTF earned 15%, which is slightly less than the half of the 33.8% total earned since June 2024. And as I already mentioned, the fund UTG earned the bulk of its 55.8% returns after entering CEF Mastery qualifying status in November of 2024. In total, 3 AI picks, UTF, UTG, and BUI, are now CEF Mastery qualifying funds, and we can move them down here with the rest of them. Now at this point, if you are thinking that what I did is not fair, I can't just add AI's returns to CEF Masteries. My reply is the market is always moving, and you shouldn't be so attached to positions that you aren't willing to be flexible. Also, that's not what I'm doing. I'm just setting things up for a later segment in the video. But since we're talking about it, if I were to steal those returns, it would only add about 0.2% to Mastery's 18.3%. Now on to returns for the past year, October 2024 to October 2025. The rate of return slowed for both AI and CEF Mastery. AI pulled in an average of 12.6%, while CEF Mastery pulled in an average of 18.3%. But as you can see, there are moving parts going on here. 3 of AI's picks acquired CEF Mastery qualifying status, while 4 CEF Mastery picks lost CEF Mastery qualifying status. We already moved AI's qualifying funds down here with CEF Mastery, but what do we do about the 4 CEF Mastery funds that lost qualifying status? Do we sell them? This is an important question, and one that I am often asked by CEF Mastery members, to which I generally reply, one report does not make a trend. Then I'll go on to point out that it's important to know why the fund lost its qualifying status in the first place. Is it a one-off occurrence? For example, the fund STK lost qualifying status after issuing a $3.07 special distribution. As you can see from this chart, STK has issued special distributions before, but not on this magnitude. And taking that much working capital out of the market is most assuredly going to have short-term negative effects, so it's no surprise that STK would have lost qualifying status temporarily. Next, look at the fund EXG. This fund had just raised their distribution 18.81%, but they had the misfortune of closing out their reporting period at the end of April when markets collapsed due to the fear of tariffs. Had they reported in May or June when markets started to recover, they likely would not have lost qualifying status in the first place. So this could be a hold. Triple QX and SPXX. Both funds raised their distributions in December of 2024 when they still had CEF Mastery qualifying status, then lost qualifying status in August of this year. I'm sure if I did a deep dive, I could find the reason why these 2 funds lost qualifying status, but I don't think it's necessary because of the abundance of distributions remaining for both funds here and here. So I don't think losing qualifying status would scare me out of any of these funds. So now the question begs, when would I sell a fund that lost qualifying status? If you suspect the reason of losing qualifying status is going to be an ongoing concern, case in point, the bear market of 2022, while the market was on its way to a negative 24.8% decline, CEF CEF Mastery qualifying funds were losing status at an unbelievable rate. CEF Mastery started the year of 2022 with 112 qualifying funds. Come October 2022, there were only 5. Exiting those funds as they lost qualifying status not only would have saved you from numerous distribution cuts, but market declines before the cuts as well. And while many funds were cutting distributions at the time, 3 of those 5 remaining CEF Mastery qualifying funds were literally increasing distributions at just about every declaration. While we're on the topic of distributions, let's review distribution activity for our funds. When I designed CEF Mastery, I had intended on its claim to fame to be avoiding distribution cuts, which would provide investors a stable income. I did not foresee the success that CEF Mastery was going to have with distribution increases as well, because at the time, and even till this day, I had no idea how generous or how stingy fund managers were going to be when it came to increases. Since CEF Mastery's inception in 2020, holding a CEF Mastery qualifying fund has increased the likelihood of a distribution increase in one of those funds by 73%. And we need to look no further than our current funds to back this up. Starting with AI, they had 5 out of 10 increases for a 50% success rate and no special distributions. CEF Mastery has 15 qualifying funds under its column, with 13 increases for a 76.7% success rate, which is consistent with our lifetime 73% success rate. If you think it's unfair that I moved AI's 3 qualifying funds to the CEF Mastery column, okay, I'll concede that. After we redo the math, that gives us 12 qualifying funds with 11 distribution increases for a 91.7% success rate. In the special distributions, and that's 14 increases among 12 qualifying funds for a 127% success rate. If you think I should exclude the funds QQX, EXG, STK, and SPXX because they are currently non-qualifying funds, I wouldn't be able to do that because all these increases happened while they were qualifying funds. In conclusion, just a brief results summary. The market returns for AI's top 10 are leading CEF Mastery's top 10 by 2.1%. CEF Mastery's funds are fundamentally stronger than a year ago and still fundamentally stronger than AI's top picks. But currently, the market has a slight bias towards AI selections of funds, despite AI's return rates over the last year having diminished somewhat from 15.1% gained in the first 4 months to only 12.6% gained in the last 12 months. CEF Mastery's picks, on the other hand, have gained returns momentum over the past 12 months of 18.3%, surpassing the 7.2% return rate in the first 4 months. So Mastery's funds have had the wind at their back lately. That's going to conclude our AI versus CEF Mastery comparison, but before I conclude this video, let's see how well these funds performed using my other system, the Divi-X system. There are links in the description below if you want to learn more about anything in this video. I'm not going to spend a lot of time on this. If you like, you can pause the screen and go over the results. I just want to quickly make a few points. 1. Divi-X has improved the results of every fund over the last 16 months, except for UTF, BME, and the rolling quarterly NAV funds FUND and RMT. I do not recommend using rolling quarterly NAV funds while using the Divi-X system. It's best to rely on a stable distribution for Divi-X and the fact that RQNAV funds alter their distributions almost every quarter. It doesn't disqualify them, but makes them less dependable. Over the long term, I think they will do great using the Divi-X system, them, but the more unknowns you can avoid, the better. Point number 2, over the last 16 months, Divi-X has enhanced some of the returns of AI and Mastery's picks quite well, but on average, the results for AI are 5.91% greater, and for Mastery's picks, the annual average is up only 3.87%, including the rolling quarterly NAV funds. Now, I know that 3.87% doesn't seem like a lot, but the signature characteristic of the Divi-X system is that the longer you hold, the more that spread widens. For example, we only have a 3.87% spread, but next year we might have a 4.22% spread, the year after that 4.96, the year after that 5.9, and then 7.2, adding a total to our return of 5 years of 26.07%. Now let me show you how this actually plays out while using actual returns for the stock MCD, McDonald's, over the last 20 years. Notice here for the 20-year history of McDonald's using Divi-X versus without, the signature characteristic I was referring to, the longer you hold, the more the spread widens. Notice here after 10 years, Divi-X was outperforming without by nearly 54%. At 15 years, over 130%, and at 20 years, 239.5%, for a 20-year annual average outperformance of almost 20% a year. And it doesn't matter about the time frame. Let's zoom into the first 5 years of that McDonald's investment. Just like in our CEF Mastery portfolio using Divi-X, after the first year, the spread is around 3%. And the spread, or the distance between Divi-X and without Divi-X, continued to widen year after year until finally after 5 years, Divi-X added over 25% to your total returns, adding a plus 5% annual average to your returns. Now a word of caution. It won't always be rainbows and unicorns. A couple years ago, I started the Divi-X high yield portfolio for my newsletter subscribers in July of 2023, put on full display my confidence in using the Divi-X system using real money. Going back to the beginning of this portfolio, it didn't take long for the market to make me look like I didn't know what I was talking about either. By October of the same year, in 2023, the S&P 500 dropped 5.75%. The high yield funds I held in the portfolio declined by over 7%. My Divi-X position declined almost double to a negative 14.87%. But I wasn't worried because I know my system. As you can see, as of today, not only did I get that 14.87% back, the Divi-X high yield portfolio is beating the S&P 500 by nearly 14.25 percentage points. Without Divi-X is lagging by nearly 23%, which is no surprise. The S&P 500 is growth oriented, and growth will usually always outperform high yield. I think at this point it's also very important to mention that the yields, that the distributions from these portfolios are not reinvested, or else returns would be materially higher. I think that makes these Divi-X returns all that more impressive. Now let's go over what can happen in a doomsday scenario. I'm going to give 2 examples. Going back to our 20-year chart of McDonald's, we're going to focus on what happened after the crash of 2020, which is right around here. In our McDonald's example covers the period of 2005 to 2025. So when 2020 happened, we were 15 years into our investment. Just prior to 2020, McDonald's reached an all-time high with Divi-X of nearly 971%. After the crash of 2020, it gave back a mind-numbing 120%. That's enough to make anyone sick. Even though the returns were unrealized, let's face it, most people would internalize those gains and already consider it money in their pocket. So to experience such a loss would be devastating. But put in proper context, even though 120% just temporarily vanished, it was still up over 130% more than if you had not used Divi-X in the first place. I'm not going to lie though, such a scenario would still make me sick to my stomach. But what are you going to do? Not make an extra 130% because you might one day have to endure a 120% 120% decline that will likely recover over time. Honestly, what I would do is set an acceptable loss rate, and if it reached it, stick to it and sell it. Buy it back when it's cheaper. For our next example, we'll explore a happy doomsday scenario, if there is such a thing. I've showed this chart to my members in the past. It is a 20-year chart of the fund PHK from 2004 to 2023. Over that 20-year period, the fund lost over 65% of its share price. And had you held PHK the whole time, after 20 years, you would have only averaged 5.6% a year. But with Divi-X, those returns nearly doubled to 10.1% a year. What is also remarkable is that over the same period, PHK reduced its distribution by over 60%, from 10.11% in 2004 to 3.98% in 2023. With Divi-X, you weren't immune to the cuts, but you would have started 2004 with a yield of 13.74%, and despite all the cuts, your yield on cost would have only been reduced to 8.79%, almost 121% greater than the 3.98% without Divi-X. Okay, that's a wrap for this video. I hope you found it useful. Please like and subscribe for future videos. Again, if you would like to learn more about anything in this video, you can reach out to me directly or check out the links in the description below. Thanks for watching.